Happy Friday, folks. I hope you have great plans for a holiday weekend coming up, but I want to talk to you guys about what in the world's going on with mortgage rates over there. We started the week, the rate was 6.9, now we're up to almost 7.2%. What's going on? So let's go over to the economic calendar. Let's kind of summarize everything that happened so far this week and then what happened just this morning. And I think it might be turning the tide on, is the Federal Reserve going to raise rates, cut rates, or are they going to be neutral? Well, you're going to see from the CME Fed Watch tool, what the Federal Reserve's proposals are at the next meeting. So without further ado, let's get to it. So here's what we have the economic calendar for the week. So we go into the week. Sunday, Federal Chairman Powell spoke, didn't really make any changes there. And then you start getting the data that we have this week. So let's summarize this. We have existing home sales. Last reading was 4.2. Now it's 4.1, so that's coming way down. Crude oil inventories, we won't focus on that right now. Initial jobless claims, it came in a little bit better. So this is initial jobless claims. So the numbers went down, meaning less people got laid off. So that was kind of a little bit of a market mover right there. Wasn't a big miss. Manufacturing is right on point. Then you have the servicing sector where it's still saying people continue to spend money, and just like the government. I'm going to show you that here in a second. So last reading was 51, it went to 54. This is how much people are spending on services. New home sales basically fell off a cliff as well. So we have existing home sales dropping quite a bit and new home sales dropping as well. Then we had the durable goods orders, and they were expected to just plummet. They were previously at 0.8. This number started at 2.2, and I'm going to let Rick Santelli at the New York Stock Exchange explain this to you, and then I'll be right back. So let's get over to it. And if you would, Rick, take it away for me and bring everybody up to speed on what's happening in today's market. Let me get all this out of the way so you can see all the details from Rick Santelli. So take it away, Ricky.
Let's get over to Rick Santelli. He's standing by at the CME in Chicago.
Yes, Becky, April preliminary read for durable goods expected to be down 0.8%, so down close to 1%. Comes up a winner, up 0.7%, up 0.7. And in terms of revisions, I'll get to those in a moment. Now, if we strip out transportation, it's still fairly lofty and well above expectations at up 0.4%. And if we look at capital good orders, non-defense ex-aircraft, a proxy for capital spending, expected to be up 0.1%, also coming in better than expected, up 0.3%. And finally, let's switch from orders to shipments. And orders for shipments are up 0.4%, and that, of course, is also better than the 0.1 expected. So we beat on every line. But here's the issue. This is preliminary. If you looked at March's preliminary, they were very lofty. The headline was 2.6 and ended up 0.9. So from preliminary to final reads, we get big revisions. And that 0.9 just actually became revised again in March to 0.8. So it started out 2.6, ended up at 0.8. So we want to be very careful. It's a very volatile series, but still numbers are better than expected. And that does put a bit of a upside move in interest rates. Now, considering we're currently trading at 4.49 in a 10-year, that is up 7 basis points on the week. 4.94 for a 2-year puts it up 11 basis points on the week. We've had some significant psychological moves on the interest rate side because of the uncertainty, and I'm using the word that was in the minutes to the last meeting, with regard to the Fed and their GPS on interest rate cuts and where the economy is exactly. And also, we have supply coming over the next couple of weeks, and that should underscore the rate game, because many believe, and I do as well, that one of the key ingredients that's keeping rates a little bit hotter than many would have suspected, in addition to what the Fed probably isn't going to do on the easing side, our debt issues and the auctions, which put it right in investors' faces every week or so as to how much issuance we're doing, which underscores how much spending that is behind it.
So what he's saying right there at the end, he was saying spending and all this other stuff and issuance getting pushed out there. So here's what happens is our government, we have no money. Okay, because we have a deficit, meaning we have lack of, the resources to pay all of our bills. So every time they give a giveaway or they send money somewhere or all these perks to things, they have to issue bonds to bring in that money. Okay, like we use our credit cards, they use bonds. Okay, so what he's saying is they're pushing tons of bonds into the market. Well, what do we know about bonds? Let's get over to this real quick so I can give you basically a little educational class on that piece of the equation. So right through here, what we know on bonds, and this is what we focus in on every day when you guys watch me, is what's going on with mortgage rates. So we watch this bond right here. This is a mortgage-backed security bond. You can see that right up at the top, okay, MBS. So what that is the price of a mortgage bond. All right. How do you figure out what the rates are doing? Well, watch this bond. Okay. All you need to know is if the price of the bond is going up or down. Okay. Here's how it works. If the price of a bond is going up, which we've had a huge rally right through here, after they dig into some of this data, that means rates would come. If the prices go up, rates come down. If the prices go down, rates go up. So this is the best trigger or best way to figure out what the heck's going on with mortgage rates. We don't watch the 10-year Treasury. We don't watch a lot of the yields that Rick went over. But here's the concern. It's fiscal spending. Okay, so even Federal Reserve Waller, Fed Reserve Governor Waller says what? The government debt is unsustainable, and we just can't continue to go down that path. And this is what's causing the basically the spread between bonds, 10-year Treasury bonds, and mortgage rates should be about 1.5%. Okay, so you should be able to take the 10-year Treasury at 1.5%, and that's what the mortgage rates would be. Well, right now the 10-year Treasury is about 4.6. Okay, so you add 1.5 to that. Okay, so what do you have? 6.1. Where are we? 7.1. Okay, so there's a disconnect between this. So when people ask me, like, Dan, what's going to go on with mortgage rates? I'm like, I have to defer to, I don't know what the Federal Reserve's going to do. I don't know what the federal government's going to do. Okay, so those are the big dilemmas we have. You can even see that right through here. Jamie Dimon, he runs the JP Morgan Chase. He's the CEO. All right, here's what he says. Jamie said on Wednesday, and it was this Wednesday, urging the U.S. to reduce its fiscal deficit sooner rather than later, warning the issue will likely become far more uncomfortable. It is continuing to be overlooked. So everybody keeps saying, okay, we just want free stuff from the government, yet, but it has to be paid for somehow, folks. Okay, so that's the one piece of the puzzle I want to look. But now you go over to the CME Fed Watch tool. What is it? So you go through here and it says, what is the likelihood the Federal Reserve will change the federal funds target rate at the next meeting? Well, the federal funds target rate or the federal funds rate is basically interbank lending. If one bank at the end of the day needs money, they go to another bank and they get that money because they have to basically have certain reserves each night before they close the doors for solvency reasons. So if they are short money, they might go to another bank and say, hey, we need some money overnight so we can close our books and be solvent. Okay, so that's what the federal funds rate is. But here's the kind of wild part. If you go down through here, it's actually, I was like, whoa, that chart's a little bit over to the left. Well, now this chart is signaling possibly rate increases. Okay, the federal funds rate right now is 5.25 to 5.5. Okay, so there's a 99% probability that we're going to stay right there at the next meeting. But there's 0.9. Now this wasn't here before. It was actually lower before, but now it's increasing rates. So the markets are all over the board when it comes to a lot of this stuff. All right, so next thing is, and let's give you some good news, or at least some tips for the day before you go out into the world. When is the best time to buy a house? Okay, I know I pivoted really quick on that, but that was my rant on the Federal Reserve and the federal government spending and so forth. So you have to continue to watch the federal government spending and all the perks they keep giving, because the more perks they give out, that means rates are going to have to stay higher for longer. Okay, so now you might say, Dan, I'm watching your videos on how to buy homes and things like that, but what's the best time to buy? So there's an article just posted this morning. I want to just go through it with you. It's really interesting because we say the same thing. We're like, as soon as the Super Bowl hits, our phones just start ringing off the hook. And it says right here, spring's probably the most ultimate time to buy a house for people with families, kids in school, and all that other time. But is it actually the best time to do that? Well, let's go down through here. You're going to have more homes for sale, but you're going to have more people bidding on those homes. So spring is a prime time for open houses, but it's also going to be a prime time for competition. Then you can start going into the summer. Is summer a good time to buy? Well, yeah. Summer months where inventory houses for sale is at its highest. Of course, there will also be a lot of competition. But then you get into fall, and this is kind of what we see. we always say, if you really don't have, you don't have to be out of your house at a specific time, maybe look at the latter part of the year, like the fall. Why? Because you might have slower buyers, not as many competition, and people are more resilient to maybe lower their prices for you because they don't have a lot of lookers at that time. Now, the winter time, I'm in Chicago. It's probably really hard to, look at homes in the winter, but that might be one of the best times you have when it comes to price, not selection, but price. So you have to kind of weigh the two there. But it also depends on, do you have kids? Do you have to uproot them and move them and all that other thing? So I just wanted to give you a little bit of tidbits on that one as well. So my name is Dan Frio. I do this report every day to keep you guys informed. And some of these days are really hard to do these videos because there's not enough juicy information out there and there's not enough market reaction to really make this exciting. But I try to do the best I can. So if you're out there and you're looking to maybe refinance, there's a lot of people calling to refinance who bought about 6 months ago at high levels, and now they're saying, hey, if it's not going to cost me much, I'm looking to refinance. Or you're looking to buy your first house, second house, maybe investment property. We'd love to help you. So go to the rateupdate.com. The first thing I want you to do is, if you're a new home buyer, before you do any applications or anything, go up through here and click the grant button. See if you're eligible for any grants out there, because there's a lender out there right now. I was going to bring up this article today, but there's a lender out there doing 100% financing on homes right now. And the tough thing about that is it reminds me of the subprime days back in 2008. One of the reasons why a lot of people got forced to sell their homes in 2008, they were over leveraged. So be careful when you get, down payment assistance. Watch to see if it's a grant that needs paid back, or a grant that's forgivable, or a loan that you have to pay back as well. What we offer right through there are grants that there is no lien on your property, there's no payments, there's nothing. It's forgiven. The money you get is actually just given to you. You walk out of the closing and there's no repercussions. You don't have to pay it back. There's no liens. There's no tax consequences or anything. So if you're out there looking to buy your first house, please check that out first and then go over to the application link and get the process started. But if you're out there and you're like, hey, Dan, can I call you guys just to avoid all this stuff? Because I don't like going on the web and all that. Sure. Just go down the bottom of the website and it's right there. You can give us a call at 844-775-5626, or you can even email me directly. And mine is dan@therateupdate.com, and I'd love to answer any questions that you guys have. So feel free to email me as well. But first and foremost, have a safe holiday weekend. Be careful out there. It is a crazy world right now, and all I wish you the best, and God bless. Hope you watch my videos later. And if you haven't subscribed yet to my channel and you're finding value there, please do me a favor. Just click the subscribe button right over there. I think you'll be happy. If you're in this the process of buying your first house, I think you're going to learn a lot from my videos. So thank you so much. Again, have a fantastic weekend. I'll see you here next week. Bye-bye.